Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. October's inflation data is out, and it looks downright nasty. Let's start by looking at the good news, and we want to be positive. There are hardly any categories that saw deflation month over month. That's it. So we've got that going for us, which is nice. Now let's get to the bad. Shelter costs, which make up a third of CPI, jumped 0.5% for the month and 3.5% versus last year. Used vehicles notched another 2.5% last month and 26.4% versus last year. Fuel oil spiked 12.3% for the month, adding to the 59.1% increase versus last year, and energy accounted for 2.2% of the 6.2% inflation reading. So, it should be obvious, but inflation is getting worse, not better. In fact, many categories saw inflation accelerate last month. For example, seasonally adjusted used car prices were down 1.5% from July to August. That turned upward 2.5% this month. The number of deflationary categories dropped from 12 last month to 9 this month. As we noted above, despite wages moving higher, folks are still poorer when you include inflation. This data says the transitory nature assumed by the Fed is persistent. And yesterday, Fed Chair James Bullard said he expects 2 rate hikes next year. Markets are pricing in a near-certain rate hike in July of next year, the month we called out earlier last month. Now, traders have priced in a 44% chance of a 3rd rate hike next year. Gold prices, a common inflation hedge, spiked almost 1.5% after the data released this morning. The bottom line is this: we don't think that this is going to get better anytime soon. Expect prices to continue to rise through the end of the year. As that continues to ratchet up expectations for further rate hikes, we could see equity markets start to turn lower. That's all we have time for today on The Juice. Click, follow, and subscribe to The Juice email for your daily dose of market minerals.